Hey, hello, and I welcome you to today's weekly market outlook here together with Admiral Markets. My name is Klatt, and I'll present you some of my thoughts and my views on the market for the upcoming week. It's somehow a special week. It's somehow a shortened week. We have the Easter weekend next weekend, and due to this, probably volatility will be lower than usual. So probably we have some difficulties to spot, let's say, spectacular market moves or something. But nevertheless, I think there's a tendency which we can already spot today, which points to, let's call it a clear advantage probably, especially when looking at equities, when seeing the current drift on the upside in the DAX, currently reconquering 12,000 points, for example, while dollar JPY is going for 112, and probably will see a bigger squeeze above that level if today's data set around the Michigan consumer sentiment, which will be published at 2 p.m. GMT, comes in better than expected. Last numbers for March were revised higher, for example. So usually this is not a big data set, but in the current environment, probably we have a tendency to a risk-on mood. And what could be one of the drivers here, probably anticipation of a solution in the trade war/trade negotiations between the US and China. So interesting enough, this is also of interest in the days to come then before Easter. Low volatility, seasonality is bullish for the S&P, for example, too. And all this combined is pointing to gains in the equity market or in dollar JPY. But before we start, we have to have a look, as usual, at the risk disclaimer, and then we take it from there. So trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. The whole risk disclaimer can be found on the website admiralmarkets.com. For further information, you also find the contact details there for the customer support. We'll have this here within this slide in a few seconds too. Regarding risks and especially regarding the differentiation now between retail clients and professional clients, the so-called ESMA decision coming into effect from August 2018, we want to nevertheless dig a little deeper into this again. So there is such a differentiation now between retail and professional clients, especially in regards to the max leverage which is available for retail traders. So when trading Forex majors like Euro USD, for example, we have a max leverage of 1 to 30, while on Forex minors like, let's say, Euro Australian dollar or GBP against NZD, for example, you have a cap, the leverage cap at 120. The same is true for CFDs on indices like the DAX 30 or gold, where you can only use a leverage of 1 to 20. And that's not only that, but there's also a big difference between retail and professional clients. There is the question around the negative balance protection, which is not available for professional clients. Usually it's not, while retail clients are protected against negative balances to an unlimited amount here. So professional clients, in case of Admiral Markets, nevertheless, have a special offering here being made from Admiral, saving them up to £50,000 according to their policy. Regarding all informations around this topic, feel free to reach out to Admiral directly. Also, if you are probably interested in being reclassified as a professional client, there's certain criteria you have to meet. Therefore, all informations they can be found on the website, respectively, where you can find out if you're eligible or not. And there's also then the chance surely to reach out to the customer support for further details on that. So then, this is me. This is the face to the voice you're currently listening to. And here the question surely arises, why Admiral Markets? So I'm located in Berlin, Germany. So in fact, we'll have a further slide in a few seconds here, which also shows the global presence of Admiral Markets. But in case of me, I'm located in Berlin, Germany. There's also an office from Admiral Markets here in Berlin, Germany. And what I can tell from personal experiences is that when referring to Admiral Markets, and it doesn't matter if you're talking about Admiral in webinars, if you're trading, talking among traders, if you meet other traders at trade fairs, for example, what you usually hear is when it comes to trading the DAX and a very, very competitive broker with its offering here in this regards, Admiral Markets is always named as the so-called DAX expert. It's also true that Admiral has a very competitive offering in regards to FX. There especially, it definitely makes sense to reach out to the website and find further information on the offering Admiral Prime. And yeah, this gives already a quite round picture, let's say, a clear picture why Admiral Markets is a very, very good choice and definitely worth a deeper look here. So then, one word global offers. I already mentioned this. There's several cities in the world where Admiral has an office. It's not only that Admiral is registered and authorized and regulated by the FCA in Great Britain, but also, for example, that there is a license here in Australia, for example, the AFSL, Admiral Markets Pty Limited. What this could mean for your trading, feel free to reach out to the website, contact the customer support for further details on that. So there are the contact details, so phone number and also the email address. Feel free to reach out to Admiral. We want to now have a look here at our agenda for today. I already mentioned several aspects we want to cover in the upcoming minutes here. Nevertheless, the questions we try to answer are, what are the key economic events in the coming week of trading? So all in all, again, Easter weekend ahead of us. So especially into the second half of the week, the liquidity and volatility and also the economic calendar will potentially thin out, and it will be subdued price action, let's say. Nevertheless, in the first half, things are nevertheless interesting. Then we also want to answer the question around the current bias in the FX, equity, and commodity markets. To be honest, it's in fact a very interesting question, especially looking at the euro currently, and then looking at the comments made from US President Trump on, I think it was Tuesday, when he was referring to the WTO and their statement on the subsidizing of Airbus from the European Union. While this may have a negative effect in regards to trade when it comes to the US company Boeing here. And so based on that, you usually wouldn't really expect the euro to take off after Trump then mentioned that tariffs in around 11 billion US dollar may be on their way, and usually you expect then the euro to somehow lose ground against the US dollar especially, which is not happening. And the same is, by the way, true for the bearish reaction you usually expect then here for the DAX, for example. Not happening. That this is not happening is probably a sign of strength from the euro, respectively underlining what I just already mentioned around potential anticipation of a trade deal being announced between the US and China, which could then positively spill over to the eurozone. So that's probably something already worth mentioning here in terms of the current bias. And then sure, the question which trading opportunities may arise. Yeah, I think this is already then answering to some extent the question from Dan here in the chat box. So regarding the ideas, yes, we definitely want to have a look and see whether we can find some ideas. So well, yeah, there we go. I mean, Euro USD is now going higher here and currently pushing above 113, capable of stabilizing above that level. And the break obviously does not happen. We surely have to have a look here back at the rate decision from the ECB on Wednesday, but what's, by the way, a surprise for me. To be honest, last week when I prepared the week of trading for my trading in terms of trading itself, but also research, I was really surprised, and I thought it was a mistake when I saw that there was a ECB decision on Wednesday, on the, in this case, 10th of April. Because usually it is 6 weeks from the last meeting, and the last meeting was on the 7th of March, so we're not yet 6 weeks from that date away. And then on top of that, usually you have the ECB on Thursday, not on Wednesday. And I found out that it was completely right, and that this time was different. Potential reason for that, I still don't know if it's really the case, but when looking at Easter next week, probably the reason why the ECB came out with their decision now some days before, probably that has to do with the fact that we are here now facing the Easter weekend, prolongated, thinning out liquidity, and probably the ECB wanted to avoid big volatility being brought on its way due to an announcement which is interpreted in one or the other way from market participants, and then resulting in a strong imbalance here in regards to supply and demand, and resulting in a sharp squeeze in one or the other direction. Probably this is the reason for that. Still, I don't know. It's purely speculative if this is the case or not. But what I can surely say in regards to the ECB is they didn't deliver anything new, which comes to some extent as a surprise, because the statement from Donald Trump. By the way, I have it prepared. Wait 1 second, please. It's here. So there's the statement from Trump. This is from Tuesday. The World Trade Organization finds that the European Union subsidies to Airbus has adversely impacted the United States, which will now put tariffs on 11 billion of euro EU products. The EU has taken advantage of the US on trade for many years, and it will soon stop. So this is the clear message being sent from Trump. And by the way, Mario Draghi was also asked here what he says, and he said this is clearly shattering the confidence and the trade between the US and European Union. But it doesn't seem as if the ECB here is really scared of the European Union drifting into a recession here. I mean, there are several reasons to be really skeptical about the overall economic outlook for the Eurozone. Let's first name Germany here and the clear signs of a recession. We can also name the still ongoing uncertainties around the Brexit, and still no deal being struck here, and another extension of the deadline, which is not solving any of the current issues between the EU and the United Kingdom. And potential negative effects this has not only on the trust in the business relationships in general between especially Germany and the UK, but in general for the overall European economy here. Then we surely have we have potential negative effects from such tariffs, and this tariff threat, let's call it, or I shorten it to TTT. It's the Trump tariff threat. And if you combine all this, I mean, then there's certainly the EU at risk of drifting into a recession. And you usually would expect the ECB to counter this outlook here to some extent. Sure, they announced these TLTROs again. That was at the last meeting. Again, this is also surprising in regards to last Wednesday. The ECB didn't mention any details on that. Which came as a surprise, could be to some extent being interpreted as somehow hawkish, even though it's difficult to say that, because it's, I mean, is it really hawkish if they do not announce any details? They said they have to wait for further details. There was, I think it was in the morning of the same day, on Wednesday, there was an article in the Financial Times showing the effect of the former TLTROs, and it could be seen that there's obviously a clear sign of a clear sign of not being enough demand in the market. So usually you bring these TLTROs up to somehow induce credit growth especially, give cheap liquidity to banks, which they then forward to especially the private sector, to especially help them to gain their productivity, gain their business. And so far, from the last two tilt rows which happened, nothing like economic, respectively, especially credit growth, could be seen. And so it's like, it's like Einstein once said, it's like this is crazy, doing the same over and over again and expect a different result. This is the definition of craziness, and this is the thing where I had to smile a little when Draghi said that they have to wait if there are any positive effects or how this will play out or so. So with this in mind, the overall reaction at first glance wasn't such a big surprise. It was like you somehow expected the euro then to trade back towards 112, which in fact happened, but into the evening then we stabilized and we pushed back towards 112.70 or so. So all in all, put this in a technical, look at it from a pure technical perspective, what you can clearly see is we're still trading in a neutral range and nothing really happened on this ECB decision, even though now we're taking on some momentum on the upside. And I want to give my thoughts on this. The thing is, if you look at the DAX, if you see this bullishness here, and if you see that we're currently going for the yearly highs, which can be found at around 12,020 points, we are really about to see a quite strong weekly close. So to me, it wouldn't come as a surprise if we are not going for another push higher, especially if US equity markets come in stronger. And we probably test the region around 12,100 points. If you wonder if I have a position on, yes, I have. It's in fact a system-based trade, but I'm long with a small position in the DAX based on the thoughts I just present you now, because this was already something which came to my mind yesterday. That was especially true. In fact, it's now playing out really well. But the initial idea was a pure technical one. When looking at the hourly chart here, what you can see is that the DAX yesterday saw a push lower that was already in the morning, and we didn't make it below 11,830 points. That was a low which was marked already at the beginning of the trading week, and in fact it's nearly falling together with the highs from the 19th of March, which were the yearly highs. From there we pushed lower and then we took off and made new yearly highs. So the former resistance zone is now becoming a support. So from a pure technical standpoint, I was quite confident that we're probably about to make it to 12,000 again today, and that's why I took the trade. I knew that I would be long for today. Usually I have the chance to intervene and to say, okay, I know that the system is, or the strategy I'm trading in the DAX is a profitable one for a very long time span, so 10 years plus. And my discretionary interventions usually then go that I say, okay, I know about the overall positive expected value of the strategy, but I try to smoothen the equity curve by somehow discretionary intervening into the system and trying to dodge, for example, bigger drops on the downside. So which means nothing more than if I'm long, or if the system is long and I say, well, we are very extended on the upside and I don't think that we have so much more room on the upside, but it's more likely that we'll get to see a bounce from here, or at least a stabilization, and at the end of the day I'm right on this call. I see the basic strategy, for example, generating a loss of 50 points or so, and I didn't take the trade. I can write down in my trading journal, okay, I performed 50 points better than the basic strategy, and so I have a plus 50 written down there. The same is true on the other hand. So if I'm wrong, if I say, okay, I'm not long, but the market squeezes higher and then closes, let's say, 100 points higher, and the basic strategy generates a profit of 100, why I skipped the trade and I said, well, I was just wrong on my view here. I have to write down minus 100 in my trading journal, and I do this over and over and over again, and then at, let's say, 100 trades or something, I see if I perform better or worse with my discretionary interventions. If I perform better, keep it up and try to keep on making the strategy more profitable. If I didn't succeed, and if I made the strategy with my interventions worse, well, I have to stick to the basic strategy. It's a better idea than to intervene and think I'm smarter than the system is. So this is in fact what I do. And for today, I knew I would be long, and I was very confident in this trade. In fact, sure, it could play out worse in this case and could be a loss for the day, sure, but nevertheless, I'm not really surprised seeing the current move here in the DAX and the push towards 12,000 points. And I'm also very confident that there is a higher chance of further gains in the hours to come, especially if US equity markets keep on performing well. And the reason for that, why I mentioned this, is the reason for my optimism currently is that you can not only see it in the DAX, but also when, for example, looking at the US dollar JPY, which is currently going for 112.10, the current yearly highs on the upside. And the Japanese yen being under pressure, such a market environment is usually a sign of risk on mode. So the JPY is a currency which is used for so-called carry trades. So due to the fact that it's nearly it's a yield free, the interest rate here in Japan is 0. So you can very cheap borrow JPY, and then you switch over to yield attractive investments like in the currency universe, Australian dollar, or currently also US dollar, but also in New Zealand dollar, for example. You're looking for equities and all this, and this usually then results in the JPY being under pressure in a risk-on market environment due to the fact that market participants borrow JPY. But, and this is the thing, if this switches and we then see anxiousness, we see nervousness, we see market participants being scared, and unwinding those carry trades, usually see the JPY strengthen in such an environment. So if you have a risk-off move, equities being under pressure, it's not uncommon that the JPY strengthens again. And this is mainly due to the fact that those carry trades are unwind. So now the thing is, if you are bullish for equities, this is one thing, but when looking at, especially in this case, JPY, and seeing it under pressure, it somehow gives you more confidence in this view. And the potential explanation for this is that market participants are obviously expecting some kind of trade deal happening between the US and China. So this is my only explanation right now. Even though we still have no deal, it still seems as if market participants are about to anticipate such a trade deal here, in fact. And again, in this regard, I think it makes sense to have a look at the website from Admiral Markets. So this is, by the way, the economic calendar with all the events of next week. So Wednesday, for example, this is definitely of interest. As you can see here, there's the inflation rate from Canada. It's definitely very interesting to have a look here, and I wouldn't be surprised, to be honest, to write a piece here on the technical side and the potential influence of the inflation rate on Wednesday. So watch out for such a research piece here in the days to come. Next week on Tuesday also we have the climate count change, so employment situation in the UK. Due to the Brexit uncertainties, probably it's not resulting in so much volatility, but still you can see there's some data which is coming in which could result in some volatility in the FX markets. And by the way, you can look this up yourself on website admiralmarkets.com, and then you go to analytics, and there on the Forex calendar, and there you can not only individualize here the time span you want to look at, but also the filter. So which countries are of interest for you. So for example, Australia, Canada. So you can obviously see I have the G8 in this case, but you could also focus on South Korea, for example, or Singapore, whatever. But why do I mention this? Well, below Forex calendar, you have the traders block. And if you click there, you will see, oh, by the way, I have to just think a little. Okay, no, it's not. This is where usually, for example, the weekly market outlook is published. But what I want to show you is in fact a technical piece. So it is in fact below technical analysis. And then you will see that there is a piece for dollar JPY with a focus on the Michigan consumer sentiment here, which could here act as a bullish driver for dollar JPY. And this was published already in the morning, and if you click on it, you will get the idea in a written format, which I just present now to you here in a spoken way. So last data which was published, in fact, the data itself is not really a game changer or something. So it's not similar to a rate decision from a central bank or so. It's only the Michigan consumer sentiment. But in the current environment, it could certainly have some positive effects, or it could probably result in a very positive outlook among market participants when it comes to U.S. yields. So currently, we keep on stabilizing here. As you can see, 2.54. When looking here at the last 3 months, 6 months, let's have a look here. You can see that after we pushed significantly lower, especially after the Fed came out quite dovish on the 20th of March, you can now clearly spot market participants becoming more, let's call it risk oriented. Probably this is a very good way to put it. So I'm not sure why this is not working here, but usually you should see a blue line now. It takes some time. There we go. So there you can see yields bottoming out to some extent and now going probably for reconquering this level. In the current market environment, usually you expect yields to strengthen in a market environment in which market participants are looking for yield. Why is this the case? This has to do with the fact that the greenback, the US dollar, is considered a safe haven, especially when volatility is very high. And this usually results in market participants then having high demand for safe havens or something which played as a reserve currency / safe haven a currency for a very long time span, and this is especially true for the US dollar. So they are not looking at things like the current debt level of the US or something, but what they look after is what happened in the past, which currency was there for me if you want, and it was the US dollar, and that's why they then go after treasury notes especially, and buying in times of anxiousness, nervousness, and all this. They buy those T notes, and this is usually then, or not just usually, but it results in a high demand for the T notes itself, but yields are dropping based on that. And this is usually in a risk-on market environment the opposite effect, which means they are selling those bonds then because they are not nervous, but instead they are looking for yield, which is then usually driving yields higher. And currently, with the outlook of a trade deal being struck between the US and China, chances seem high that the US yields will probably push higher from there. And this is especially true if then another potential positive effect, like a good reading on the Michigan consumer sentiment, is published today. It was already revised higher last month. This is something you can see here. So the data is expected to come in at 98 after 94. Interesting enough, 98.4 was the revised reading. So before it was for March coming in at 97.8. So there was already a positive reading, and probably also possible, and this is what market participants could see in such a good data set, is that they're probably considering a good reading be an indicator that the only reason which is currently resulting in let's call it below expectation readings from an economic perspective is that businesses hold back as markets have to wait a deal to be struck between the US and China in terms of trade. So every good reading could point or could accelerate such a speculation or such an anticipation of a trade and result in dollar JPY to push above 112. And yeah, that's why dollar JPY is very, very, very interesting. And if we go, by the way, above 112 today, and if we're closing the week above that level, well, then things are getting really interesting, because we have a thinning out market environment in the days to come, which is usually good for carry trades, because in such an environment you usually do not see a big fears brewing or something, but usually you see just the market keep on trending in the direction it currently is trending to. What does this mean? Well, that means nothing more than if we break above 112, we should expect dollar JPY to keep on going higher, due to market participants keep on selling JPY or borrowing JPY to fund their carry trades, which then usually would result in a next target being activated around 114.50, 115 probably. So dollar JPY seems to be an interactive risk-reward trade if we break above and close above 112 for the week here, since we then have further potential on the upside up to 114.50 to 115. Yeah, so that's it in regards to dollar JPY, and yeah, so it perfectly fits the picture here in regards to the DAX. What's nevertheless of interest is the following: rising US yields, risk on, and well, then the question arises, okay, why is euro gaining traction against the US dollar then? Because if the US dollar where US yields are rising, usually you expect the yield differential between European and US being a driver for strength in the US dollar and weakness in the euro. Probably especially after the ECB makes, in my opinion at least, the impression of somehow losing control to some extent. So there were plenty of remarks from Mario Draghi during the press conference where really was like, did he really say that? For example, like there was a question from a journalist which was referring to the negative effects of negative yields to the European banking sector. And there was also, not only that, but there was also a disadvantage now for European banks depositing their money at the European Central Bank for being punished for doing so with a negative yield here, minus 0.4%, while in US banks, for example, they get yield for depositing money with the Fed. And the gap we're talking about is there was someone who calculated it up to, I think, 50 billion or so, which is enormous when especially looking at the already let's call it eroding income or banking model and their income streams in general. And yeah, Draghi was like saying, well, it's not I'm not ceding him here, but it was if you listen to him, it was like, yes, we are aware of that, and I'm sure we are currently analyzing the effects of negative yields on the European banking sector. And you're just sitting there and just thinking, you implement negative yields, and then you find out that it's probably not such a good idea and completely against the overall banking system or their business model, and leaving them struggling with how to generate revenue. And you can't think about this before you implement negative rates, but you have to think about this now and see that it's probably not working, which is like, yeah, it's very, in my opinion, it's very difficult to understand that, to be honest, because the models, and obviously the ECB is very model oriented, let's say, the models also point to no real fears of a brewing recession in the Eurozone. That was also a question, and Draghi said, well, we don't see any signs of a recession right now. This is especially funny because when looking at the latest economic data coming from Germany, you can clearly see that there is massive signs of economic slowdown, and it's very interesting to see the ECB not being somehow feared or scared of a recession in the especially biggest economy then of the Eurozone. But this is just noise, let's say. It's just an impression at my end. What I'm somehow interested in is why can the euro present itself so strong against an overall solid US dollar, and this is something you can clearly spot when looking at dollar JPY, for example. And the reason is, or it seems as if market participants now, when looking at a potential deal being struck between the US and China, they see potential positive spillover effects on the eurozone, and a potential trade negotiation or trade then being done with the US. And the interesting thing about this is that such a view is coming into a market environment which is already, and this website is barchart.com. I highly recommend it for a view here, futures, and then the commitment of traders report. This is where you get some information on how big speculators are positioned. And when looking at the currency section here, Euro FX, it's only something like 6 to 8%, but it's already giving a good indication of where we stand here. And when looking at this, data will be updated today. So this is the data which came in last week on Tuesday, and probably data which comes in today is not really full of information, let's say. This has to do with the fact that the data is from Tuesday this week, and we had on Wednesday the rate decision. So the real interesting data is coming in next week, then on Friday. So we still have to wait 1 week for that. But nevertheless, what you see here is that currently there is nearly 100,000 contracts, market participants being 100,000 contracts short the euro and expecting it to break significantly lower and below 112. And the current move probably, when it goes hand in hand here with what I just presented on the DAX and on dollar JPY, and the anticipation of such a trade deal being found between the US and China, well, this could be not based on optimism around the euro, but it's probably a short squeeze currently initiated in a quite thin market environment, which is currently driving us higher. And not sure if there's enough momentum, but currently it doesn't really seem as if you should short this momentum, but probably you should be probably really careful with especially short-term engagement, but instead then go for intraday long engagements based on a pullback. So looking at a structure, for example, on M15 in this case, and what you can see is here that the market already started with a sequence of higher highs and higher lows against here 112. And then you can see that we've broken higher here. That was overnight, so this is today. And then now it looks really extended already here on the upside. So I wouldn't really be long here now into the weekly close in the euro. But if there is a pullback against 112.90 or so on the downside, I'd probably look for long engagements in the euro and go for at least another retest of the region around 113.20 or so. And this is, I think, especially interesting because you can work with a quite tight stop here, even though you have to be really careful. So only working with a stop here at 112.90 is probably a little too much, but or it's too tight, let's say, but based on a volatility from a volatility perspective. But nevertheless, it seems still more attractive to be positioned on the long side in the euro currently than being positioned on the short side, since so far the US dollar seems to have trouble to gain momentum against the euro, which is a currency where market participants are already quite short positioned in already. And so this is definitely something to be aware of. So if you if you're looking at the currency market currently, dollar JPY from the long side seems to be interesting. Euro USD seems to be interesting from the long side. This is especially true then for Euro JPY, for example, to look at it from a long perspective. And but I see that we definitely have to cover the DAX now into the end of the webinar, and then also we want to have a look at gold. But the DAX is currently more important since it's from several perspectives, a very, very interesting market. Also, I think from a risk-reward perspective, from a seasonal perspective, from a technical perspective. So there's several reasons to be quite optimistic for the DAX. So I already mentioned that next week we have the Easter weekend, which is usually going hand in hand with the drop in volatility. So this is usually something you should expect from the second half of the week onwards. In fact, DAX will be closed on Friday next week, and also next week on the week after on Monday. It's different to the U.S. markets. I think U.S. markets are open on Monday, but this is something I have to look up. Nevertheless, what's of higher interest is definitely the question: what is meant with positive seasonality? In fact, I'm looking here at the U.S. equity markets, which are still presenting themselves in a very strong mode, and I have to say, I'm really confident that rather sooner or later, probably before Easter next week, we are making it up to the current all-time highs, which can be found at around 2,940 points. And in the shadow of the S&P, it wouldn't come as a surprise if the DAX continues to perform on the upside and stabilize solid and probably significantly above 12,000 points. And the seasonality, which is of interest here, is the following. So I've written it down already. 1 second. Let me just enlarge this a little. So it's the E-mini S&P on which I'm looking here, which is the in fact underlying on the S&P SP 500 here as a CFD, which you can trade when trading with Admiral Markets. And in fact, during the time span from the 15th till 19th, so the next 5 days, next week, the 5 days from Monday till Friday, you have usually a long seasonality. So over the last 21 years, there was in 16 out of 21 of those years, so a hit rate of 76%, there was an average gain of 21.5 points, while those times when we lost, we had an average loss of 9.9 with a max loss nevertheless of 28.1. So from a pure statistics standpoint, the next week seems to be to have a clear advantage on the long side. So the week before Easter, not only due to the drop lower in volatility and potential speculations about a trade deal being found between the US and China, but also from a seasonal perspective. And with this in mind, chances seem very, very good that the DAX here will continue with its run higher, especially now after we made it back above this purple line. This is the simple moving average 200, and a potential target on the upside can be found around 12,450 to 12,500 points, with next targets then on an intraday basis being found at 12,100 and 12,200 points, in my opinion. So for today, it's it wouldn't come as a surprise if the DAX continues to perform well on the upside and go for at least a test of the region around 12,100 points. And in the days to come, I would be really, really surprised not to see the DAX go for a stint up to 12,450 to 12,500 points, while US equity markets have a very, very solid and good chance to go for a test for their all-time highs. So in case of the S&P 500, then 2,940 points. Yeah, and gold. A final look. Wait, where do we have it here? So the head shoulder formation is still in play. I made it a topic at last Monday in a technical piece, which was published on the website from Admiral Markets here. And so yesterday was a very interesting day, because from Monday till Wednesday we had a push higher up to and back above 1,300 USD, and then within minutes, let's say, there was a clear acceleration on the downside here, and the question arises, why? Where did this selling pressure come from? And in my opinion, it came from a data set which at first glance didn't seem to be so exciting. It was the producer price index, but it came in significantly above expectation, and that's interesting because the day before, on Wednesday, numbers around the consumer pricing, so inflation, came in mixed, let's say. So there wasn't such a clear tendency on the upside. And why is it of interest? Because it could show problems of the Fed, which they find themselves, or a very difficult spot in which the Fed currently finds itself, because on one hand they have consumer prices stabilizing, and so from this perspective they don't need to act in regards to further rate hikes, and especially this is especially true and important when looking at the latest FOMC statement here, and the fact that they don't see any rate hike in 2019 while they see only one in 2020, and then producer prices increasing, which could show that businesses or companies, they have trouble to keep their profitability or the level of profitability in their business, because usually they have rising costs, and then they just put it on top of the price, and this is usually what you then refer to as inflation. And probably this is something to that the Fed has to look at here, to be careful in regards of this aspect of diminishing profitability of U.S. businesses. They're probably forced to be more restrictive in their monetary policy, and probably consider at least a rate hike, which would be, after the latest reading or latest statement in March, very hawkish in my opinion. And this is explaining, in my opinion, where this push lower in gold happened then and came from. And so that said, now looking at it from a pure technical perspective, this head shoulder is still in play, and if we break below the neckline, and especially if we break below 1,275 USD here, further losses down to 1,240 USD are very likely, and therefore you just use this this projection down to the neckline from the head here, and then you put it here at the neckline, and you get out at 1,240 USD here. So, and yeah, that's it from my end. I hope you enjoyed this webinar. So next week the day will be off because markets are closed on Good Friday. So we talk again to each other then in 2 weeks from now. And yeah, I wish you all the best. A nice, enjoyable weekend ahead, and then a nice and enjoyable Easter. And talk to you again then in 2 weeks. I really look forward to it. All the best. Happy trading. Watch your stops. Enjoy yourself. Talk to you soon. See you, and bye bye.